Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today we're going to be analyzing Zoetis stock. The stock's down about 25% this year, and even more than that off its high back in 2020, early 2022, like 40%. So trading quite a bit off its high, not quite at the lows of the decline in late 2022. But we'll see where the valuation is today. As always, this is not individual investing advice. This is just how I analyze stocks. I'm going to be using fast graphs today along with my spreadsheet in the full Cyclical Investors Club service over on Seeking Alpha. I will have a 25% off discount link for those who haven't used fast graphs before down in the description of the video if you want to check out fast graphs. And then if you would like to join the full Cyclical Investors Club service, I have a free tier over on Patreon. That's the best place to start. And if you join there, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And I'm done with my pitches now. So let's get into the valuation here. So quick thoughts. 27 PE, pretty high, but really nice steady growth. So these guys do, it's a pharmaceutical company, but it's for animals, and a global company. I glanced at the annual report. It looked like about half the sales come from the US, half come from the rest of the world. The balance between, there's the distribution, I guess, or share of revenues from like cats and dogs and domesticated animals versus livestock, which is another big area for them, varies a lot from country to country. In the more developed countries like the US, it's more like 2/3 from domestic animals and then 1/3 from livestock, whereas in more developing countries that's kind of reversed, just as a general rule, or somewhere in between, like 50-50. So in general, I think this is a pretty interesting business, and I definitely don't own anything like it right now. I think the cultural trends are such that people are willing to spend more money on their animals, their pets. So I think that is pretty unique, but what we don't have here is any real recession data. We only have data that goes back to 2015. We do have a little bit from 2020. I don't know if the more pinched people felt economically during a recession, how economically sensitive the domestic market would be. Probably would hold up pretty well unless it was a really bad economic situation. That's my guess. And then they do have the livestock portion to balance things out. So I think there will probably be a little economic sensitivity, but nothing too crazy to make me think this is like a super cyclical stock. Despite the fact that the price is down, what did I say? It is down, we'll call it 40% off the highs, even when the rest of the market is probably about flat since 2020, the beginning of 2022. So definitely underperforming the market in terms of the stock price. Now, my initial reaction just from looking at that is, well, it was crazy overvalued at 50 times earnings. Earnings growth looks like it's slowed down quite a bit from the previous period. So this kind of multiple compression sort of makes sense to me just glancing at it. But I'm going to run the numbers, and actually I had more data going back, but it doesn't. It goes back to 2013. So it still doesn't go back to the Great Recession. I'm going to use this time frame, this closer time frame, so that's why I had it there. So let's just run some of the numbers. This is going to be an earnings-based analysis. Typically, I use past earnings trends to try to forecast the future. For pharma companies, this can be a little tricky. One of the reasons the stock went down, I believe, is they had some sort of negative side effects with one of the new drugs they were developing. So that's part of the explanation. That's very pharma specific. So that could affect the future earnings growth potentially. I don't know the details about that, but it's something to just keep in mind that this isn't going to operate necessarily like a normal business, like a normal business that's just creating the same products or services over and over again. Because it's pharma and drug related, it's going to change over time. But I do think the overall demand is going to be there for in the industry, basically, going forward. So let's just look at the numbers and then we can kind of talk about some of this extra stuff. So when I look at the time period from 2015 to 20, like this decade right here, using these forward earnings, this is the time frame that I'm looking at. When I do that, I get about a 13 to 14% earnings growth rate. These guys are on the high end of the 13. So what do I have? 1356. The only adjustment I made was because they bought back about 8% of the shares during this time. That inflates the PE number a little bit because the shares get reduced. So FastGraphs is just slightly higher than me, but pretty much on target. They've grown earnings 13 to 14% during this decade. So that's what I'm going to forecast forward. I would keep in mind that analysts are expecting less than that over the next few years. So that could be optimistic on my part, but I also think inflation might run hotter. So maybe the analysts aren't fully accounting for that yet. So you can just kind of, I think it's a reasonable estimate to use. I always try to have a margin of safety anyway to take kind of account of these things. So the way I do this is I try to think as a business owner how much I could collect from earnings from this business over the next 10 years. And then I create a CAGR out of that, and that's what I use to value the stock. So they're expected to do $5.79 in earnings in 2024. I think we have one report in already. So that's what I'm going to use here in this initial analysis. And then they have just a tiny bit of debt, it looks like. So I adjusted the $150 price up to $159. In order to get that, I take the difference in the market cap to the total enterprise value. I'm not sure I adjusted this for this recent stock price decline, but it's going to be pretty close. So after I do that, I get an earnings yield, which is the inverted PE ratio. So earnings over price. It's basically the same thing as the PE ratio, but this one has that small adjustment for the debt at 3.64%. Okay. So the way I think about this is if I bought the business for $100, the business would earn $3.64 this year. I pull forward the first year's expected earnings growth. And then each year that $3.64 would grow at that 13% or so. And what I want to know is how much money on my $100 investment I could collect in 10 years. And that comes out to $78.27 on top of my original investment. So you can plug that into a CAGR calculator. So you start with 100, you end with 178 over 10 years, and you should get something close to this 5.95% CAGR. So I consider like 6.5 to be the midpoint of like fair value, generally speaking. If it's over 8%, then that's kind of the buy range that I'm looking for. If it's under 5, then maybe selling is in order. Just you can kind of, you're at least thinking, I would at least think about it depending on all the other factors involved. This is a little better than the market. So these recent declines have made it more attractive than the average stock, which is maybe more like in the S&P 500, more like, we'll just call it 5.5-ish. But if I adjusted this earnings growth rate to what they're expecting, which maybe is more close to 11%. So now we're back down to like market value, right? So some of that is just explained by I have a little bit more optimistic earnings growth than what analysts are predicting. So basically pretty similarly valued to the S&P 500 using current earnings estimates along with the previous earnings trajectory. I would say it's close to fair value, all other things considered, maybe still slightly overvalued. Now, here I use 2020. I also have a thing called recession PE, but I don't have 2008 recession data, so I have to use 2020 data, which is probably not pessimistic enough, but it's something at least to go on. So when I do that, without getting into the details, because I kind of did this in several of the other videos, but basically I take the low price of this drawdown, which is under 100. Actually, it was like 90, and I compare it to the peak earnings per share, which is $3.64, and I create a PE out of that. So in this case, that PE was 22.35, okay? And then I don't make any adjustments to that because it's such a high PE to begin with. So often multiples can compress like below that. I am a little bit more conservative when I calculate this right now for these guys because I'm using this data from 2023 that's already come in, and I'm treating this as kind of unreliable. So if they disappointed again and this came in at $5 a share, I would still keep using this peak PE number to calculate it. Whereas the other basic earnings analysis would continue to get worse and worse as earnings estimates got worse and worse. So the PE, the recession PE, kind of anticipates a recovery back to this peak at some point in time. This is kind of the idea behind it. And otherwise, if the market tends to get negative and negative and negative when things get bad, and so the stock price gets lower, but the calculations basically would stay the same because earnings growth is bad. Earnings expectations are bad. So I try to take that negativity out and just kind of use a little bit more rational approach that it's a good business. Eventually they'll recover, even if it's a recession, type of thing. So when I do that, the stock price would need to fall about 25% to 112 would be the buy price. If you use the traditional method to get this up to 8%, it needs to fall to about $101. So this kind of area here should offer a pretty decent entry point. And like I said, if earnings went negative, you can just kind of make a judgment call as time goes on. But I think this is probably, this number would keep getting lower. So I think this 112-ish level is probably where I would be aiming. It looks like it's at 150 right now. Kind of looks suspicious because it's exactly at 150. Yeah, that's about right. So yeah, about 25% lower. I think and that's regardless of what these earnings do. So the way that would happen is either the broader market, these guys miss earnings maybe in their next report or something, and then you get another big sell-off, and then I would basically ignore all that bad news and come in and buy at 112 or whatever. So, and the idea would be at some point in the next few years that would recover. So that's the approach I would take. It has sold off a lot, but it was very overvalued or richly valued at a 50 PE, when so far since then they've only grown earnings in single digits. So that sell-off is just totally explained by that. There's no reason for a business or a stock to be trading at a 50 PE when they're only growing earnings at 9%. So yeah, it's a good idea not to just base it on how far it's fallen, but to think about whether it was ever justified to be that high of a price to begin with. Okay, hopefully you found this useful. If so, hit the subscribe button, hit the like button. I have a free Patreon tier too down in the description. Make sure you join there, and you can get more direct access when I do post things there that I don't post on YouTube sometimes. But if nothing else, you'll make sure you get all the YouTube videos sent to you. You won't have to go searching for any of it. I'll see everybody later. Bye.